Hello and welcome to Macroeconomics. Today we will be discussing the Phillips curve, that is the relationship between inflation and unemployment. To build a model to describe inflation, we need to split it up into three separate causes. Changes in expectations about future prices, demand pulling the prices up, and then on the supply side, increased costs pushing those prices up. The inflation caused by each of these three components can be added up to get the total consumer price index inflation figure. Boom, boom, boom. Inflation caused by changes in expectations, inflation caused by increased demand, and then inflation caused by negative supply shocks. Let's go through these. First, expectations. How do beliefs about the future change what we actually see in prices in the future? Like, what's the mechanism? In one word, it's contracts. Firms write contracts laying out their plans for the future. They will need to consider expectations about future prices because those prices will end up in the documents. And therefore, when the future arrives, previous beliefs about the future become the future. Some future contracts are just a few months out, while others last for years. A mortgage contract, for example, lasts for 30 years. Once you write down those numbers and sign at the bottom line, years later, those prices manifest. There's a lot of different ways that people formulate their beliefs about future prices. One is adaptive. Today's inflation is simply going to be tomorrow's inflation. There's a persistence with this type of belief. Anchored. There's a lot of trust in a country's central bank that they will be able to maintain that 2% inflation target. So if we see some bumps along the way, we know in the long run we'll come back to that 2%. You'll see economists write that expectations are still anchored. There's a rational way, and that is relying on expert analysis and expert forecast, taking in all of the available information and making our best educated guess. Sticky expectations are when we don't update them despite having new data. And we see generations that grew up, say, in the 70s when we had very high inflation for a decade, continue to believe that we'll see inflation even though the macroeconomy has completely changed since then. These beliefs about the future have a powerful effect. They can lead to virtuous or vicious circles. First, we'll do the good news. If you expect lower inflation, then we get lower inflation. And then when we saw we got lower inflation, our expectations are confirmed, keeping that virtuous circle. But on the other hand, if we expect higher inflation, then we will see higher inflation, thus confirming the negative view, exacerbating future expectations, leading to that vicious cycle. We can see this happening in Argentina for the past few decades. This particular graph is looking at the consumer price index on a monthly growth rate. So in 2017, it's not just 2.5% a year, it's 2.5% a month. And over time, it just keeps growing. That vicious cycle of increased expectations continues to worsen their situation. One of the crucial purposes of a central bank is to break these vicious cycles, set expectations appropriately, and help sustain trust and confidence in a country's currency. And the Fed doesn't just change interest rates in order to change expectations, but they spend a great deal of time carefully communicating to the public and providing what we call forward guidance to indicate their path of future monetary policy. And this can help lower expected inflation in the future. Take Chairman Powell here.
We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run.
So expectations are kind of funny because they're about beliefs. How do we measure them? Well, we simply ask them. The University of Michigan does one such survey. This particular graph asks what people believe inflation will be 12 months from now. Of course, most striking is back in the late 70s and 80s, inflation expectations were completely unhinged relative for the United States. February 1980, we have a reading of 10% per year inflation expectations. That was a big part of the story. And so the Federal Reserve at the time, led by Paul Volcker, needed to break these expectations, and they chose to raise the interest rate up to 19% in order to change the public's expectations about prices in the future. And, well, it worked. Expectations plummeted down to 3% by 1983. And between 1983 and 2019, those nearly 40 years we call the Great Moderation. Inflation expectations remained stable and anchored the whole time. They rose again after the pandemic, but have since been subsiding. Instead of asking people, we can ask businesses, and we can also ask them about longer periods of time. The green line here represents the 10-year expected inflation rate. In 1982, the figure was 5.8%, and it slowly slowly declined down to the 2% range by the 2000s and has largely remained there since. Similar to the consumer 1-year expectations, the 10-year figure did go up a little after the pandemic, but always stayed within a normal range. And finally, the one that I think is the most revealing is what we call the break-even inflation rate. So the Treasury issues some of their debt in inflation-protected bonds. That means if the CPI unexpectedly changes, the interest rate on the bond will also change, keeping the real interest rate constant for the duration of the bond. Well, some of them have this inflation protection, while others don't, and people can trade between them. And the price difference between them we can use to calculate what the market believes the inflation rate is going to be in the future. The reason I love this so much is because it's not a survey of beliefs or sentiments or feelings that somebody could just write on a paper, but an actual bet that people are doing with real money. It's a revealed preference, not just a stated preference. And what we find through the 2000s, this 5-year expectation has hovered just a little above 2%, coming down in 2015, falling during the recessions, of course, but peaked at 3.5% in March of 22, and like the other measures, has come down. These measures of inflation expectations tell us that in the 1970s, high expectations mattered. They were fueling some of that decades-long inflation. And then from the 80s through the 2010s, we see that virtuous circle of stable inflation expectations. And then finally, in the post-pandemic inflation period, while there was a slight rise in expectations, changes in expectations were nowhere near enough to explain the increases in prices we saw in 2021 and 2022. The red here shows the CPI inflation rate. There was a big gap between measured inflation and changes in expectations. So, what does that mean? Tune into the next video where we will discuss how demand and supply shocks affect prices across the economy.